Welcome to Let's Buy Property. I'm your host, Tony Amato, co-founder and director of Amato Property, buyers agency focused on helping home buyers find their perfect property in the Newcastle and Lake Macquarie region of New South Wales and investors across Australia. So whether you're looking to invest, relocate to this amazing part of the country, or just get a feel for the local market, you've come to the right place. Today, we're tackling one of the most crucial aspects of buying property, securing finance. So whether you're a first-time buyer or an experienced investor, navigating the mortgage process can be daunting. That's why we're joined by Shae Cameron from Mortgage Choice, a seasoned expert in home lending who's here to share tips, bust myths, and help us better understand how to secure the best home loan. Shae Cameron, thanks for joining us.
Thanks for having me, Tony.
Mate, my pleasure as always. Buddy, I thought we'd kick off with just a bit of an introduction. So I was wondering if you could share a little bit about yourself and your business.
Yeah, I spent 25 years working on military jets in the Air Force and for other military contractors. I went to a mortgage broker to buy a second property after being turned away initially from the bank, and that started my curiosity about becoming a mortgage broker as I learned more about loan structure, negative gearing, cross-collateralization, depreciation schedules, and things like that for investment properties. So I wanted to learn as much as I could about the property and finance so I could start to make educated decisions on how to invest. I left the Air Force and started working for a brokerage in Sydney back in '05 for a short period of time after I left the Air Force, not realising how long it can take to get paid in the mortgage broking industry and having bills to pay. I went back working on jets, but it was always something that I wanted to get back to, and I did back in 2022 and decided to start mortgage broking again to help people essentially buy property, as I've always had a keen interest in property myself and have invested myself in property since my early 20s.
Yeah, fantastic. It's so, I mean, we've done I think this is the 5th interview we've done on Let's Buy Property. And as we go through interviewing experts, it's so common that people go through this personal experience of the whole property buying process and find something they think, man, I want to know more about that. And then they go out and make a career out of it. So it's just this common ribbon that sort of runs through, which is quite interesting. It must have been a bit of a change from military to finance.
Yeah, it has been, but it was something that I've done for such a long period of time and tried to invest a lot of time and money as well in educating myself, and read, like a lot of people, a lot of books about investing and about buying property. And it is a complex web of a lot of people that you need to, I suppose, trust and also, use their expert knowledge on to try and help the buyer, or as you being the buyer, navigate through so much complexity, I suppose, that can entail buying a property, from start to finish, and whether or not that's being a first home buyer or whether it's being a seasoned investor. There's always things to learn, and there's always things being updated in the industry and changing in the industry.
Yeah, 100%. And that complexity and trying to understand, the different sort of products that are out there. And you touched on some of the buzzwords, so I'm sure we'll get through to that a little bit later. But I suppose to sort of move further in, why should someone choose to work with a mortgage broker instead of managing the process on their own?
We have access to like multiple lenders that some people may not have heard of. So we use essentially expertise and we try and guide our clients through the loan process and the different products. We can save a lot of time because we can compare different mortgage options out there through multiple lenders and make the process a bit more efficient. And we're also here to help you get the best loan we can that suits whatever your personal goals are and objectives are.
Yeah, that time, saving time and those the different options that majority of people wouldn't even know about is I think is real value that you bring to the table. So that's you I mean you've obviously worked with quite a few clients over your career. What are some of the common challenges that borrowers face during the application process and how have they best overcome those?
I think one of the big things is understanding what your borrowing capacity is and what you can afford to purchase, and also what the costs are that are involved, like lender's mortgage insurance, stamp duty, which is now transfer duty. Understanding all those things and having a clear understanding of what your budget is really important before you start, really seriously putting in offers on property.
Yeah, that budget, like setting that budget, and I think what we find with our clients is that sometimes you'll get clients coming in with a budget, and their expectations of what they can actually purchase with that budget is so far removed from what you can actually purchase. It's quite daunting to sort of navigate that with them as well to get that reality check, I guess, as well. I mean, you probably come across that yourself.
Yeah. Yeah, it is. In this market that we have at the moment, it's really important. And there are buffer rates and things like that people probably don't understand, which can impact borrowing capacity. And we've had a huge, I suppose, increase in property value, which which has sort of affected most states all around the country, really.
Yeah, absolutely. Absolutely. Now, mate, you mentioned just then about, the different facilities, offsets and all that sort of thing. So, I mean, there's obviously a lot of loan options out there, fixed rates, variable rates, offset accounts, like you said. How do buyers decide which is best for them?
It really depends on the individual and what their risk profile is. So, for example, fixed rates are great in that they give you certainty. So you know exactly what your monthly repayments are each month. So it can help you budget. They're not going to change. Whereas the variable rates will fluctuate with rising and falling interest rates. So it really depends on what I suppose what your risk profile is. There are pros and cons to both. I don't think there's a right and a wrong. It just really comes down to what you're more comfortable with. Sometimes most first home buyers will be more inclined to maybe fix because their budget might be really tight. Whereas seasoned people who have been in and had mortgages for a long period of time might tend to have variable options. Due to they know that the economy sort of changes, and we go through different periods of boom and busts, and typically they'll ride those out and try and take advantage of variable rates when they fall. That's
Yeah.
one of the downsides, I suppose, to having a fixed interest rate. If you can't take advantage of any falls if the interest rates go down. But yeah, so that's really comes down to what the individual's comfortable with.
Yeah. And with the fixed interest rates, is it still correct that I mean, there's usually a limited amount of extra repayments you can make on those fixed interest rate products, or has that changed?
No, that's still the same. So you will have limited payments with some lenders about how much extra repayments you can, and there are costs as well associated with if you want to try and break that fixed in the event that the interest rates do fall dramatically. So and that can be expensive as well. So but in saying that, it really just depends on the borrower,
Yeah.
essentially.
I think it's so typical with the whole process is you've really got to tailor everything to the buyer, the client that's sort of sitting in front of you. I mean, we certainly have to do the same.
Yeah.
So so in terms of, the features of the loans, what are some features in a loan that borrowers often overlook, but should really consider?
Flexibility, I think, with repayment options, what we just spoke about. So can you make extra repayments? Are the repayments, are they limited? Are you able to redraw from the loan those extra repayments? And are the redraw payments limited as well? Are things I think that you can overlook, but I think it's really important, like that flexibility. And also, are you looking at paying the loan off earlier, and will there be charges and fees that are applied, if you do intend to try and pay the loan off early, how's that going to impact you? So I think those things are pretty important and really worth looking at.
Yeah, and is that something you'd go through as part of your process when you're sort of organising finance for clients? Is that, looking at, what you're setting up and what fees are attached to all those sort of scenarios?
Yeah. Obviously, typically the more flexible the loan product are, they will come with certain fees, associated with that particular loan, and you've got to really weigh up, I suppose, what is it worth it? Is it worth it to you?
Yeah.
Is an offset, having that offset account and being able to use, say, for example, the offset account to try and minimize interest over the period of the loan. Is that worth something that and having the flexibility where you can move money around from accounts and put extra repayments in and then withdraw those payments if need be for emergencies and things like that. That really comes down to the individual, and there is a cost that generally comes with those type of accounts, but it depends on a basic account, versus like a packaged account or
Yes.
a packaged loan
Yeah.
facility. So
Gotcha. So, mate, I mean, we've known each other for a little while now, and I mean, we've often spoken about the first home buyers or first time home buyers. What would be your number one piece of advice for a first time home buyer looking to secure a loan?
I think for first home buyers, save early.
Yeah.
Start saving early. That's really important to just save, get the biggest loan, I suppose, the biggest deposit, sorry, that you can. Try and minimize your debt. So limit your debt to a minimum. So your credit cards, big personal loans, big car loans, they all impact your serviceability. So I think really if you can just start saving, minimize as much credit as you can, and also,
Yeah.
like understand the government schemes that are out there that you could be eligible for, and really get your head around those, like the 5%, home guarantee schemes and all the state and territory schemes as well. So understanding that, I think, is a really good starting point for first
Yeah.
home buyers.
Absolutely, because I think that's probably one of the biggest struggles, isn't it? Getting that first initial deposit together,
Yeah,
especially as a first home buyer, can be tough. It's a fairly big slab of cash.
it is. It is, and there are ways you can do it. There's, you know, different ways you can have parents help out with gifts and stuff like that as well. So, there are different ways that you can go about getting that 5% deposit. But I think, yeah, just start saving, minimize your debt, and just and then understanding all the different grants that are out there to help you try and get into the market, buy your first home.
Because that 5% is quite good, because that did go out for a while, didn't it? It seems to have come back in. Is that right? Or is it
Yeah,
all?
so there has been, so the government brought it in. Well, they've brought in, some different schemes have come and gone in the past, but essentially we do have high buying costs in Australia with lenders mortgage insurance and with the stamp duty, or what they call as a transfer duty. So, a 5% deposit, without, back in the old days when I first bought my first property, we had to come up with 10% essentially. It was 5% for your deposit, and then the costs associated with LMI and transfer duty, stamp duty was another 5%. So essentially, you needed 10%. But now it's just 5%, and you don't have to pay the lender's mortgage insurance or the state. There are eligibility criteria in regards to all that. For the price of the house, income, what type of wage you're earning, things like that to be eligible for those grants and schemes, but definitely worthwhile investing a bit of time and understanding whether or not you're eligible for them.
Yeah, absolutely. I mean, there's some fantastic schemes available that you should, take advantage of if you fit into that eligibility. Now, Matt, what about investors? So what should they focus on when they're structuring their loans for an investment purchase?
I think for investors is having a deposit ready to go, and same again, limiting your lender's mortgage insurance. If you can access equity out of if you've got a previous loan, and then basically getting a pre-approval in place. And there are ways to structure that where we can access your equity that you've got in a property, and it might be 20%. Generally, LMI comes in at around, if you don't have a 20% deposit. So if you can access 20% deposit in an existing property, then you don't pay LMI. So yeah, that's basically how we can do it. So we can access your deposit. We can sit it in an interest-only offset account for a period of time, and then have a pre-approval in place, and then you can go shopping and look for another investment property. Obviously, if you don't have that 20%, you can get away with 12%, which is a 10% deposit and a 2% for your LMI, that can cover that cost as well if you don't have 20%. But so there's different ways of doing it as well.
Yeah. And when you're accessing that equity on your primary home or another investment property, you're not securing both that property with the new property, are you? Not cross-collateralizing.
No. So it'll be a separate loan for the new property. So you just access. You'll have your deposit, which will be an investment. Basically, the purpose of that will be for an investment property. And that will be your deposit, and then we'll have a pre-approval for an investment loan, essentially.
Yeah, fantastic. Now, mate, like anything, I guess there's a lot of misconceptions and myths around mortgages. What would you say are some of the biggest myths you hear about mortgages?
I'm not sure about mortgages, but there are myths about mortgage brokers, I think, and how we get paid. So we are paid by the lender after the loan settles. So we're not paid by the borrower. So we're not an added cost to the loan. In some circumstances, for complex loans and bridging loans that don't have an end debt, you might get asked for an upfront fee just because of the complexity of the loan. And when there's no end debt after a bridging loan, we wouldn't get paid. So there are a couple of circumstances, but essentially we're paid by the lenders upon settlement. So that's a myth, I think, that we do often get asked, who pays us or how much does it cost type thing to use a mortgage broker.
Yeah, gotcha. And in terms of, sometimes you hear that people feel like trying to refinance or change things around with their loans, or even change banks can be expensive. Is that your experience, or is it relatively straightforward and inexpensive?
For a refinance?
Yeah.
It's relatively inexpensive. There are costs with changing, but compared to the saving that you can make from a refinance over the long term, I think it's definitely something to consider. Like if it costs, and it's going to vary with each lender, application fees and things like that. But
Yeah.
if it's around $500 or $700 to do a refi, but you're saving $400 a month, then it's definitely a no-brainer to do.
Yeah, 100%. Absolutely. So, Shay, what are some of the common mistakes that you see borrowers make when they're applying for a loan, and how can they avoid those?
Common mistakes, as far as they'll have their deposit there, and then when it comes to settlement, they might not have it there because they've spent it. But
Yeah, gotcha.
but they can go out and buy a car, and then all of a sudden, we've got to add that car or that
Yeah,
loan.
serviceability. Yeah. Because
Yeah,
like, is it often, because like you hear about it that people get their loan approval and they go to settlement and then they can no longer afford it. And is that usually because I mean, obviously interest rate increases will affect that, but
yeah, 100%.
if there's something's changed in their financial situation, or they've done something to change that?
It depends. It really depends on whether or not they've had a pre-approval, fully assessed pre-approval, or if it's just an indicative one.
Okay.
So if some pre-approvals are fully assessed and some aren't. So it's
Nice.
just based on, it hasn't gone to the credit assessing team to look over all the detail, all the documents of the loan, and then they go, oh, hang on a minute, their income's been overstated.
Yeah,
Or,
gotcha. Okay, so they can't
or
verify the income or something,
they
or
can't verify the income, or there's credit reports. So there might be loans that we haven't been able to access that they've accessed and go, hang on a minute, there's another loan over here that hasn't been added onto the servicing.
yeah.
Yeah, so there's a bunch of things that can catch people out with that, and that's where it really becomes important to have I think, to have a fully assessed pre-approval, because that gives you confidence that you know what your upper limit, what your borrowing capacity is, rather than just, hey, here you go, oh, this is what I earn and I believe you, and then you're telling me you're making 180,000 a year, and then I get your pay slip and I go, hang on a minute, you're
Yeah.
not making 180.
Probably really important as well if you're going to auction, because you wouldn't want to walk into auction with without a fully assessed
No, not at
approval.
all. You need a fully assessed pre-approval to go, to just be confident, and just there's so many things to think about, like making sure that you've got funds to complete ready to go. And that's another thing. Like, you want to have all your ducks in a row when you're especially going to auction, but even just to put your purchase on, because to get, it goes quickly. Like, once you've put in an offer and the offer's been accepted and you've got a contract to sale, you've got 5 days to go to get unconditional approval, get formal approval.
Yes.
It's not long, and that's to get everything, all your documents in, everything approved, ready to go, and then from there we're booking settlement, and that can be
Yeah.
4 weeks. So it's like, okay, get all your money.
Those timelines are super tight at the moment. We just exchanged on a property last week, and we actually had an extension of the finance clause from 5 days out to 7 days, I think it was, just to give the lender enough time to actually, fully qualify, fully assess the application and get the formal approval in
Yeah,
place. Yeah.
and see, what people don't realize is SLAs.
Yeah.
Like your
Yes.
service levels. They're
Yep.
not going to pay if you've got a service level with a bank and there are some out there that are 13 days, they're not picking up your file for 13 days, and you've got a 5-day cooling off period to get for. You've got zero. There's absolutely no chance that you're going to have that.
And so service levels, SLAs are what exactly are SLAs?
So your service levels are basically, each lender has differing service levels. So it's for the loan applications that are being submitted. So your service levels with each lender can vary depending on, how many people they've got to basically look at these loan applications that are coming in.
And is that
So
like a number of days before they can assess or pick up your
yeah,
file?
Yeah, pick up a file and
Yeah,
assess
wow.
the loan applications, and you know, like some they they're not going to get to it. You know, some service levels on some lenders are really, really good. Like they're going to look at and they can pick up the file and you can get formal like approval really quickly, like within 24 hours.
Yep.
And some are 2 weeks, 3 weeks. I've seen longer. I've seen over a month. So
Yeah, man.
you have got zero. So if you've got a contract to sale ready to go with a certain lender and their service level is, let's say, 10 days, and you've got a 5 day cooling off period.
Man, and we like as a the average Joe Blow buying a property wouldn't have any idea about service levels for these lenders.
And it's so important. It's
Yeah,
so important because there are some lenders out there, and this is where it gets so complex from a compliance perspective, because from a compliance and a bid, best interest duty from a mortgage broker, we're out there to try and find you the best loan and the best deal that we can get. Now,
yeah,
if I can get you a loan at 6%, but the service levels are at 20 days, I can't, it's impossible. Like you
yeah.
could potentially get a better loan, but because of the service levels, you're going to miss the property, you know?
You can't get the deal done.
Because we can't get that, we can't get those service levels just take so long. Whereas, and that's where I think it's really important for buyers to basically like go to a broker first so we can look at what you're looking at doing, because
Absolutely.
you know, the more time that we've got, the better the loan we can get you. We can look, if we don't have time, if we're limited on time and we've got a contract of sale that's come and we haven't even had a chance to, you're looking at service levels. You're looking at some guys, some lenders that have got the fastest turnaround times that can pick up this file today and get it serviced, which may not necessarily be your best interest rate.
Yeah, absolutely.
So there's going to be added costs associated with that. So
I couldn't agree with you more on that. I mean, that's one of the first questions we ask clients or potential clients that come to us. It's like, okay, have you got your finance organized? Do you have a pre-approval in place? Because if you haven't, we're running blind. We don't know where your budget is. And if we do find a property, we're not going to be able to move on it
yeah,
in
yeah,
fast enough.
you can't move fast enough. And
No,
sometimes in a seller's, like when it's a seller's market, like the vendor's market, they can dictate terms. And if they've got people lined up ready to go and you haven't got finance approval, you're not formal. You're gone.
you've got a chance.
You've lost the property, you know.
Absolutely.
And that's the that's a bit of an issue, I suppose we can. And I think that's important to educate as well some of the buyers that, like, you can get extensions for finance. So obviously, 5 days is quick, but 10 days, they'll extend another 5 days and generally give you another 5 days. I think 10 days is reasonable to get your formal approval done, to get formal. But 5 days can be really, really, it goes quick. And then we've got to, okay, now we're on the hook. We've got to organise settlement.
Yep.
And we don't want to hold up settlement, because settlement is, important that we've got all our finance ready to go and that settlement doesn't get held up from our end. So that's another really important aspect of it as well. So
The
yeah,
pressure's on, mate.
the pressure's on, and it really is. It's on, and especially when that contractor sale comes in, and then the valuation is really important as well. So
Yeah.
for
And,
everyone involved.
and you just mentioned the contract of sale. So do you need to wait until you get the fully signed contract of sale to be able
For
to get?
vals, to submit a
Yeah.
val.
Yeah.
Yeah, so typically most lenders will want both signatures on the contract of sale
Right.
to order the valuation.
Okay. Cool.
Yeah.
And
So
that's another
once
thing to know. Yeah.
Yeah. So once you've got, basically we'll let the, one of our clients know. They said, look, we need, as soon as you've got that signed contract of sale ready to go, then we need it ASAP to make sure that we can get the valuation done, because the valuation is critical to the application for formal approval, because that'll be a condition.
And that's where it's so important that you've got all the, like, your conveyancers or your solicitors that you're using and your mortgage broker and your buyer's agent, if you're using a buyer's agent, are all talking.
Yeah.
Because otherwise someone's sitting on signed contracts and the mortgage broker doesn't know that it's been signed, and it just puts the whole process back.
It does, and communication's key, and that is the key. It's really from the contract of sale to getting that formal approval is what everyone's waiting for, essentially. So real estate agents, mortgage brokers, solicitors and conveyancers, we're waiting to get that formal approval, because once we know we've got the formal approval, the loan's approved. So that loan applications will go through. And then it's organising settlement. So that's another thing that, we need to sort out, like loan documents need to be signed, and we need to make sure that there's funds there to complete, and the deposits go. We've got the 10% or the 5% deposit, whatever's the deposit that they convey, or whatever they've negotiated, whatever they've negotiated in the contract. So all those things need to be in place, which are really important, and they go far. The time can go really quickly, and if they're waiting for money to sell shares, or they're waiting from a gift from a parent, but they can't give the gift because they've realised it was in a term deposit, and the term, like, there's just so many things that can hold up settlement.
Yeah. So communication, absolutely, mate. All the way.
Yeah.
So, Shae, I'm just going to step back because we sort of went down this little bit of a rabbit hole, and
we did.
Just want to step back because we were talking about, being able to service and make sure you know what your budget is and how much you can actually afford. So, and obviously tied into that are interest rates, and they're always a hot topic. So, how can borrowers stay informed and make stay informed of the most current rate trends, I guess?
It's a good question. I wish I knew the answer.
Yeah.
Look, I mean, you can follow the RBA. I do. The RBA is what sets the interest rate to the lenders. So that's worthwhile. So I think holistically, mortgages are 30 years now. They used to be 20. They have gradually increased over the years. And the economy over that 30 years will boom and bust. It will stagnate. We will have recessions, as we've seen recently, and with the GFC and with the high inflation rates of the late 80s, when interest rates were up, around 17%. So, it is tied, interest rates pretty heavily to inflation. I mean, that's what the Reserve Bank talks about all the time. So to combat high inflation, they will push up interest rates to stop spending. So that gives you a bit of an idea on what to look for with interest rates. Generally, the inflation rate's around that 2 to 3%. And I'm no expert economist, but it seems to be they like to sit the inflation around 2 to 3%. And if it gets if it gets too far above that, they will use that lever and push interest rates up, and vice versa. If they want to stimulate the economy, they will lower interest rates, essentially, to try and stimulate the economy. So they'll want people to start buying more and free up cash. But the RBA seems to be a pretty good starting point to inform yourself about what you think the trend will be, I think, and just keep your ear out on the RBA.
And you might not know the answer to this, but do you see that, like, if there's going to be a change in interest rates and whether that's up or down, do you see that they change the fixed rate first before they adjust their variables, or is it, is there any sort of trends like that that you noticed?
There are trends with fixed rates, and typically from a lender's perspective, and I'm not a lender, remember, I'm an intermediary. They think that, interest rates are going to drop, like they think the next rate they're going to drop. The fixed rates have gone down. And it's vice versa when interest rates are going up.
Yeah.
You know,
Is the fixed rates first, locks
the
up your
fixed rates start climbing. As they start climbing, and then all of a sudden it's like, I'm not going to fix in at 1.5% higher than my variable.
yeah,
And
yeah.
then it just keeps climbing.
And 3 months later, you're at 4.5%.
Yeah, exactly.
Well, that was my thoughts. It was in line with what I was thinking as well. Shay, we might just change gears a little bit, and I guess a little bit cheeky, and I want some insider information, I guess. So, do you see any trends or upcoming changes in the lending market that buyers should be aware of and that they could take advantage of, moving forward in the short term?
Look, it's another great question. It's always changing. The environment always changes. And with technology, we've seen, especially since COVID, some major changes with lending, and with the Royal Commission that we've had. So I think there will always be changes with lending and lending policies. I don't know if there's anything that you guys off the back of my head or that I can think of that's going to be a huge game changer. But
yeah, because we often see things like, lenders will put out, $3,000 cashbacks for a refi.
yeah,
Like, I mean, obviously that's aimed at getting business and getting more people on their books.
it is.
How regularly does that happen? Like, is that quite common, or is it sort of just a hit and miss random?
No, I think that's just a random. It depends on the lenders. There are still a few lenders that are doing the cashback, but there's not many. I think,
Yeah.
there's not many that are doing that. They're sort of gone. I have heard that they're talking about possibly extending the loan terms long term
Right.
as well,
Yep.
but try and help first home buyers. So, as you're aware, the loan term years ago was only 20 years.
Yes. Yeah.
Then it went to 25. Now it's 30. They're looking at 35-year loan terms.
Yeah. Wow.
There are some lenders that are doing a 35-year already, but
Wow.
whether or not all the other lenders come on board and start doing 35 years, because then it increases their borrowing capacity if you can extend out that loan term.
Yeah, and that, I guess, that sort of addresses some of that unaffordability of for first home buyers, essentially, to get into the
Look,
market.
and there's overseas loans. Like, I think in Japan, you can get like an 80-year loan. Is it
Yeah.
Japan?
Wow.
They pass loans down. It's
Generational thing.
a generational thing. I hope we don't go there, but
Yeah, that is interesting.
it's to combat the high, the high cost of purchasing a property.
And when you look at that, because I mean, there's always talk, we have these booms, property booms, and prices go up, and there's always commentary around, prices can't continue to go up. They
Mm,
can't keep on growing. But
mm.
realistically, historically, it has actually continued to grow, and it's likely that it will, because you'll come up with these different systems and schemes to make property owning still affordable.
Yeah, yeah, and I mean it's all supply and demand. It really is supply and demand. How obviously prices are going up because there is limited supply and the demand is high, and what that is due to can be a factor of things. COVID and having a lot of people come back into the country that were living overseas. Obviously, they needed homes, and then we've got immigration as well. We're not building enough. The supply just isn't there. really at the moment. So the demand's high. But you do see the cycle. If you do go into, from what I've seen over the years, is once there's a bit of a recession, they will take the steam out of the economy, which is what they're trying to do now. And then typically what will happen is, wages will go up over time, like they do, and hopefully, you know, wages will go up and the property does fall. It has fallen. I've seen, Perth crashed. The market crashed in Perth not that long ago. You could
Yeah,
buy property in Perth. It was really expensive and then it crashed. And Sydney does fluctuate, and Melbourne as well, and
yeah,
Brisbane.
but
So
I think you're right. And Perth especially was, I mean, that was obviously linked to the mining and commodities, and
that's right.
there was that real downturn that
Yeah.
really Perth for a long period of time. I think their growth now is been a little bit different. It's on the back of
Yes.
different factors, but yeah, you're spot on. If there are cycles, there's probably
It
cycles.
cycles. It does cycle, and I think from what I've seen is they kept interest rates so low for such a long period of time that it drove the economy. Like it drove people. People, could afford, you know, $1 million and $1.5 million loans easily afford it. Now it's completely different ballpark.
And obviously, there's a proportion of those buyers who were on fixed rates as well that have now, they might have been fixed at 2% or 2.5%, and now that's expired and they're bouncing back up to sixes, and I mean,
And,
that's
and
what
they're
happened.
having to sell properties. There's
Yeah.
people who can't, that were on the 2% and fixed early, that know that when they come on the carded rate, they can't afford the mortgage. So they're selling their property before they have to um, be pressured to sell,
Yes. Yeah.
because
Absolutely.
they, if yeah,
Yeah.
which is unfortunate, right? Like you've finally got it into the market, and now you're forced to sell because you don't have the income to be able to afford these, which are historically an average interest rate. 6% is probably an average interest rate for Australia, for in Australia, that I've seen since I've
Yeah.
been had a loan since the
And I guess that, I mean, just speaks to the complexity of financing for property purchase and the actual property market. There's so many factors that can affect it. You've got to be on top of most things or across that as well.
yeah.
So Shay, now we've talked a lot about servicing loans and how to sort of manage your budget and work out what your budget is to be able to purchase. So once the loan is settled, what should borrowers do to manage their mortgage effectively moving forward?
I th Look, having a budget's really, really important, and knowing what your cost of living is really important, and living within your means, having a little bit of a buffer, I think, as well. And review your interest rate, every 6 months or every 12 months is another thing that you can do. So make sure that, you are paying, or the interest rate that you're on shouldn't be higher than what you can get out in the market.
Yeah, right. So reviewing your interest rate, and then I guess lead on to my next question was going to be around that whole refinancing sort of situation. So if you're saying review interest rate 6 to 12 months, 6 to 12 months, how often should borrowers sort of consider refinancing, and what sort of, I guess, are the signs that indicate it's time to do that?
Look, I think review at least every 12 months your interest rate. If you can get a better rate elsewhere, um, and your current lender won't offer you a better rate, I would start looking at refinancing. I think it's better to have that extra money that you could potentially be saving in your pocket than in the lenders. So that's when I'd be looking at refinancing.
Yeah, okay. So basically looking every 12 months, reassessing, and then finding if your lender will match or look elsewhere.
Yeah.
Excellent. Yeah, so you've obviously helped a lot of people get home loans and secure properties. Have you do you have any success stories that you could share with us where you helped a client secure a loan in a challenging situation?
Yeah, look, we did have a client who was on a significantly higher interest rate than they could get on the open market. It was about 1.5% higher than comparable rates. Essentially, they wanted to keep a property in their own name, but couldn't refinance out of this particular property. They were basically in mortgage jail, we would call it. So they wanted to keep the loan in their individual name, but because of household, the way that household and living expenses and commitments are, they couldn't afford potentially to refinance through a lot of lenders. We were able to find a policy with a specific lender that had like a policy called apportioned household expenses and commitments. So what that meant was that the portion of the expense or the commitment repayment used for the serviceability assessment was based on the borrower's contribution to the total household income. So essentially, if you've got two incomes in the household and someone's got a significantly higher income, then you can calculate the percentage of the total income. So the borrower and the spouse's income and apply a percentage. So
Right.
yeah, if that makes sense. So you
Yeah,
can
so they don't get
apply,
assessed on the total. It's basically
yeah,
just
yeah. So it's
they're
an
just
apportioned
proportion.
spending
Like,
for the commitments and the household income, which frees up, it allows them to be able to borrow and service for this loan. It essentially saved about $400 a month on this
wow, that's huge.
particular property. So they didn't think they were going to be able to do it, but with us, and that's with a lot of lenders, they will have different policies. Some are similar, but some are quite different, and they can help people that are out there on high rates. But it's sort of understanding what policy you can apply to what situation and whether or not that's going to work.
But you can only imagine the relief that client must have felt because, I mean, mortgage jail, being in mortgage jail would be
Yeah,
horrendous, like just feeling trapped. And
yeah,
then,
and those. So there are those loans and those lenders that are out there for a reason. And specialist lenders because of income, because assessing income can be complex. There could be a whole myriad of reasons why, but with that comes an extra added risk to the lender. So therefore, they will apply a higher interest rate because of the risk. And for some borrowers, that is the option, but the option is to try and get out of that particular loan as quickly as you can, so that
yeah,
you can use it as a sort of a very short-term solution, and then as soon as you can try and get out of those high interest rate loans.
yeah, move into a lower rate.
A
Excellent.
lower rate. But yeah, it's trying to find a policy that you can that a lender has that you can use to try and get out of that. But that was a good one, the apportioned household expenses and commitments, because
Yeah,
it,
that's
it
fantastic.
worked it worked well in this
Yeah,
particular circumstance.
like I said, they must have been, just so relieved to have that option as well.
Yeah.
Before we wrap it up, what would be your top piece of advice for anyone looking to get a home loan?
Is understanding what your borrowing capacity is and getting a pre-approval in place. I think that's
Yeah,
the key. It's the number one key, knowing what you can afford and what you can afford to purchase is key. It really is key.
and I think something you touched on earlier was like reaching out to you guys early
Mm.
process,
Getting
not waiting to that last minute to contact the mortgage brokers. Actually, reach out, get organised as one of your first steps.
And one thing we probably didn't touch about is credit scores and how that can impact your loan. And
Yeah.
you know, there are like credit scores and understanding how that can impact certain lenders as well. Like it's really important, and you can have, you know, the best, you know, like all the income and everything ready to go. But then because you've had so many inquiries on your loans, and if you've got a low credit score, you just can't go to certain lenders.
Yeah, that's right.
And that's probably a key thing as well, is for people to understand how, like, having zip pay, zip money, afterpay, you know, multiple credit cards, personal loans and car loans, you know, affect your score. And,
Yeah.
you know, it can fall over deals. You can lose deals because some lenders have automatic declines.
Yeah, wow.
And
Because
so
that's
you
stuff
can
like all the afterpays and zip pays are things that people just totally forget about.
all inquiries, and they sit there and, oh, I haven't used them, but they're still all inquiries that are
Yeah.
on the loan. Now, the credit score is what the lenders use for character as well. So that's what they'll say, is this person, you know, how much debt and credit are they using, and are they making their repayments on time? And if you're not, and you've got defaults and missed payments and you're in arrears, and the questions will start coming up as to, well, why have you got so much credit? Why aren't you paying for this? And then, you know, if there's quite a lot of missed payments and stuff, then some lenders, they have certain scores, like
Yeah. The
um,
red flags come up.
the red flags will come up, and that's important too. So it's there from a broker's point of view. It's yeah, really important to sort of get that authority, or get that consent first, because that can dictate what lender
Yeah, where you place the
we,
loan.
we can place the loan with. Yeah.
Yeah. Yeah, fantastic. Well, mate, Shae, this has been incredibly insightful. Thanks so much for joining us and sharing your expertise. Now, for those who want to reach out to you for advice or assistance, how can they get in touch?
Yeah, you can get in touch just through email. So it's shae.cameron@mortgagechoice.com.au, or it's www.mortgagechoice.com.au/Shae.Cameron. So you can find me on my website and book in an appointment if you'd like to talk about yeah, anything finance related.
Fantastic, Shae. Thanks again for joining
Right,
us. Been fantastic chatting with you, and to everyone listening, until next time, take care and happy house hunting.
thanks, Tony.
Thanks, mate.